Let's bring in Jenny Horne, markets correspondent here on the network, to help us break down this data, because hopefully she has better numbers than I do as I try to parse through this and talk to the camera at the same time, Jenny.
Yeah, it's a challenging task, Tom. I will give you that. But seeing, pretty much exactly what most thought, I think, coming in around 0.3% up on a seasonally adjusted basis in November, after rising, like you said, 0.2% back in the previous month. That we saw over the last 12 months, the index has increased about 2.7% before the seasonal adjustments. I think the most interesting component of this report continues to be the index for shelter, which rose 0.3%, accounting for nearly 40% of the all items increase. The food index also increased over the month, rising 0.4% for the food the food at home index, increased around 0.5%. The food away from home also rose 0.3%. The energy index was another standout, which rose 0.2% for the month after being pretty much unchanged back in the month of October. The index for all items less food and energy was up 0.3%, as we did see pretty much in line exactly with where we stood over the last 3 months. Indexes that increased, though, like I mentioned, include shelter, used cars and trucks, exactly what forecasts were expecting, household furnishings and operations, as well as medical care, new vehicles and recreation. The index for communication was among those that decreased actually for the month. And so I do think it's always important to, like we do look at the 12-month basis. I think this illustrates some of the consumer concerns that are definitely still there regarding inflation. For example, we saw the all items less food index and energy rose 3.3% over the last year. The energy index actually decreased about 3.2% over the last 12 months, while the food index remains up 2.4%. So I think that speaks to an inflationary environment, of course, easing from peak levels, but showing an uptick from last month, which, based on the market reaction, at least preliminary here, I think was widely expected.
Yep, positive for equities. Bonds basically where they are. The 10-year currently trading about 4.23%. So no real big movement there in the Treasury market. And we're going to expand that conversation with Mike Zaremski later on in the show. But we got a couple individual stories here. Jenny, the first one I wanted to hit on was Tesla. We're seeing all these price target hikes now. Yesterday, I think Morgan Stanley put a $400 price target on it. We saw some others over the last couple of days, and the optimism's back into this stock based on a Trump win and all the money that Musk put behind him. But if you just look at the valuations, it's a head scratcher, but this stock's always been a head scratcher, right, Jenny?
I know, and that's the one maybe break I give Tesla as far as its valuation, because, a lot of these names right now, Tesla, Apple, NVIDIA, Tesla different in some regard, but all trading at pretty much some of their most expensive levels ever. But Tesla hasn't exactly been the growth engine we've been accustomed to. I do think there's still a lot to be excited about in the pipeline coming this year. But Goldman was one raising its price target to $345 from $250 with a neutral rating, saying that given the reduced EV market forecast, they're lowering now their earnings estimates for Tesla, driven by lower deliveries and lower auto gross margins. However, while they do see these fundamental headwinds to the core auto business over the next year or midterm, they do see that the market is taking a more forward-looking approach to Tesla, including with respect to its AI opportunities. I do think that's why it, of course, is traded at a relatively different valuation than the rest of the auto space. And frankly, you look at the auto competition, there really isn't any, especially as far as like the electric world, because so many of these names have just not caught a bit at all, because I think it's been seen that the new administration will not be favorable to EVs, but will be favorable to Tesla. So that outperformance has been kind of remarkable. Morgan Stanley was another one, like you said, price target of $400 a share from $310 with an overweight rating. And they said that with this new administration, they do reiterate their 2025 auto forecast, noting that policy changes now present some near-term headwinds to, of course, the overall U.S. EV sales, but that the U.S. must not cede to this autonomous leadership for geopolitical rivals. They believe that we should take on a more firm stance. I actually saw one analyst say that ICE is nice, like these internal combustion engines, like a GM Ford. But again, if you want that growth, you want that AI play, Tesla is pretty much all you're looking at.
It seems like it's been on a tractor beam back to those highs that we saw 3 years ago of $414 a share. We're at $410 right now, so seems like they're getting what they want. Be careful, though, because the RSI on this one, about 77 at this point, so overbought on a technical basis. But I'm sure we'll continue to talk Tesla as we always do here. It's a mover, Jenny. And another mover this morning post-earnings is Macy. This looked like it was a messy report, Jenny.
And I mean, who could frankly be surprised when you consider, I mean, like those that are, I mean, maybe this is just my own bubble, but the nearest Macy's by me closed years and years ago, even prior to the pandemic. They've been shuttering locations. They've been really efforting cost control. But again, this has been more of a long-term story, not even just the difficult retail environment of this past year. So shares pretty sharply lower this morning after they did cut their financial outlook for their quarterly report. We saw shares drop as much as 9% this morning. But for the third quarter, they did report adjusted earnings per share of around 4 cents. That actually did top expectations. Net sales were around $4.74 billion. Nearly in line. I mean, some forecasts have that at a modest beat, but I would say that was pretty much exactly what we were expecting. But the focus, I think, is on the trimmed forecast for 2024. They now forecast adjusted earnings per share to fall between $2.25 and $2.50 a share, pretty substantially below the prior guide at around $2.55 to $2.90. Street had been expecting around $2.73 a share. They also did continue to trim their gross margin guidance to range between 38.2 and 38.3%. And they highlighted that they are still trying to improve. They're definitely still committed to this turnaround effort. But this also comes as they were supposed to report this report back on November 26th, a day before the results were scheduled to go live. They said they were pushing it back to December, and that an employee did intentionally hide up to $154 million worth of expenses over the course of 3 years. So just not the type of headline you want if you're Macy's. I think you want to ensure investor confidence in this recovery, and that has just not been the narrative. Although this does bookend what has been a very choppy and very stock winner and loser retail earnings season.
Yep, margins coming in here a little bit on that, the controls. They had to push off the results, as you mentioned. So an accounting issue. I guess that employee is gone now, as they put out in their statement. Yeah, you hope. All right. Great stuff. Thanks to Jenny Horne.